The Turkish central bank narrowed the rates corridor yesterday for a third month, leaving the benchmark interest rate unchanged. On the phone with me now is Sengül Dağdeviren, chief economist for ING Turkey. Sengül, talk us through this decision. Will it act to stimulate more lending, do you think?
I think it will, but most of the effect of the decision has been priced in earlier. Why do I say that? I think the rate cut that we have seen yesterday was the minimum expected in the market, as some were betting that there will be a cut in policy rate or the lower bound, and we were expecting maybe the CBT cut the upper band slightly faster, which they didn't. So in that regard, it is supportive of the decline in rates in general, the loan rates in the system, but it doesn't. It won't probably accelerate the fall in rates. Why I am saying that is the CBT is still maintaining the phrase in its statement which says that global uncertainties are still high and they want to be flexible on both sides, meaning that the upper band is still a binding threat for the local banks, although the effective cost of funding and the prospect of further easing is in the pipeline.
Turkish Central Bank Governor Erdem Baski hinted at future cuts. Some economists have taken this as a sign of concern at the central bank that Turkey is suffering from excessive hot money flows. Is this a sentiment that you would agree with?
Not really, although it is a potential threat or it is a potential stress point looking ahead. I think the CBT with yesterday's decision just delivering, as I said, the minimum expected cut, but they proved that there is a risk of hot money looking ahead. I think they remain ready to react to such developments. But as of today, probably we are not facing a hot money stress yet. But it is likely for 2013 more so maybe.
Earlier this month, Fitch Ratings gave Turkey its first investment grade rating since 1994. However, yesterday Moody's kept Turkey one notch below investment grade in an annual review, saying its external imbalances left it vulnerable to shocks. This paints a slightly confusing picture of Turkey's economy. Can you clarify this decision for us?
I think it's not that confusing to me, if you ask, because the Moody's is still maintaining the positive outlook for Turkish economy. I think the main reason is that the evaluation of both two agencies on Turkish economic outlook is pretty much the same on the strength side for fundamentals like the fiscal side and the economic dynamism and the market size and etc. But when I look at the announcements of two agencies, I think the Moody's seem to evaluate the outlook on the external balances, especially the current account deficit, more cautiously, and also the inflation side. The inflation forecast on the Moody side seems to be a little bit more cautious. In that regard, I think it's the preference of the agency, but it doesn't hide the fact that I think there is a high likelihood of Turkey getting another investment grade rating from another agency next year. We are still maintaining that expectation.
Despite improved credit ratings, Turkey's current account deficit is still seen at 7.3% of GDP in 2012, albeit down from 10% last year. What will the next steps be to continue to improve the country's external finances?
I think we have to keep in mind that a majority of Turkey's current account deficit comes from energy bill. I mean, as of the most recent numbers, as of September, if you exclude the energy bill from the deficit, Turkey's current account deficit has fallen as low as $4 billion 12 months cumulative. So in that regard, I think with the expectation that economic activity has bottomed out in third quarter, so we are expecting a slight improvement in the GDP growth in the coming period. I think the best thing that we will see is that a stabilization in the current account deficit in the levels between 7 to 7.5 of GDP. For further improvement in that we need much lower oil prices in the very short term if it happens, which is unlikely. But in the more medium term, of course, the efforts on the economic front, on policymakers' side to improve the savings ratio or broaden the saving base in the system, domestic savings especially, is a way to go. And also, of course, diminishing the dependence on imported raw materials, energy is a big bulk, but also we are importing a lot to produce locally, so diminishing the need to imported inputs will be very important in the coming periods.
That's all we've got time for right now. Monica Gibson will be back shortly with Nick Stamenkovic from Ria Capital Markets to discuss Spain. For now though, goodbye.